Hey there. Come on in, grab a seat, and imagine you're sitting right here across from me in my office. For today's explainer, we are going to operate like I'm your professional financial advisor, and we're mapping out a completely foolproof, mathematically optimal wealth building strategy just for you. I spend way too much time obsessing over optimal investment strategies, and honestly, it blows my mind how many people seem absolutely determined to do things in the exact wrong order. But Today, we are fixing that. We're going to build a step-by-step blueprint to make absolutely sure you are maximizing your returns. Okay, let's dive right in by confronting a trap I see almost every day. You know what absolutely drives me up the wall? It's watching people throw their money at the stock market like they're playing a slot machine in Vegas, completely ignoring the fact that they've got credit card debt charging them 22% interest, just sitting there, eating away at their wealth. It's exactly like trying to fill up a bucket that has massive holes in the bottom, and then wondering why you're not getting any closer to the top. Look, I get it. The urge to skip ahead to the fun stuff, like picking the next hot stock or the latest crypto, is super tempting. But doing that while your financial foundation is crumbling is a massive, massive mistake. So here is our step-by-step advisory blueprint for today. 1. The foundation of wealth. 2. Eliminating high-interest debt. 3. Securing your free money. 4. The tax optimization zone. 5. Avoiding the taxable trap. And finally, 6. Your monthly progress checklist. Let's start with the absolute non-negotiable first step. Section 1, the foundation of wealth, building your psychological safety net.
Think about building a house for a second. You wouldn't be picking out custom granite countertops if your concrete foundation was cracked and your roof was actively leaking, right? You have to pour that solid concrete first, otherwise you're building your financial house on quicksand. $500. That is the median emergency savings for Americans right now. It's actually down from $600 just a year ago. I mean, that's less than a lot of people's monthly car payments. That leaves millions of people literally one unexpected mechanic's bill away from a total disaster. And the crazy thing? These are often the exact same people asking me if they should be buying cryptocurrency. It's like wanting to buy a Ferrari when you can't even afford to fix the transmission on your daily driver. So our first move is rapidly building past that $500 mark. We want to get you to your first $1,000 as quickly as humanly possible, and then start building toward a 1-month and eventually a 3-month buffer. Actually, Vanguard did some fascinating research on this. They found that just having at least $2,000 in emergency savings boosts a person's financial well-being score by 21%. That psychological safety net is absolutely crucial. It stops you from panic selling your investments at the worst possible time or racking up terrible debt when life inevitably happens. Moving right along to our next phase. Section 2, eliminating high-interest debt. We like to call this curing financial cancer.
Okay, so with your safety net poured, we have to attack the absolute biggest wealth destroyer out there. Generally speaking, we define high-interest debt as anything charging you more than 8% annually. Credit cards are obviously public enemy number one here, with average rates sitting well over 22%. Trying to invest while carrying this kind of debt is literally like trying to run a marathon with a backpack full of heavy rocks. It just mathematically outpaces pretty much any reasonable stock market return you could ever hope to make. Let me put this into perspective for you. Say you have just $5,000 in credit card debt at 22% interest. If you only make the minimum payments on that, you're going to pay nearly $2,800 in pure interest over 5 years. That is your own money actively working against you. But if you flip the script and use the debt avalanche method, where you pay the minimums on everything else and throw every single extra dollar at the debt with the highest interest rate, you are essentially securing a guaranteed 22% return on your money. And honestly, getting a guaranteed 22% return absolutely crushes Warren Buffett's long-term average. All right, step 3, securing your free money, the employer match exception. Now, I know I just sat here and told you to pay off your high-interest debt before you start investing, but there is one major mathematical exception that completely jumps the queue. If your employer offers a matching contribution to your retirement plan, you need to contribute exactly enough to get that full match. Let's do the math. If you make $50,000 a year and you contribute $3,000 to get a 50% employer match, that $1,500 they put in is a guaranteed immediate 50% return on your money. Even if you're carrying that 22% credit card debt, grabbing a guaranteed 50 or 100% immediate return is a no-brainer. It is literally free money lying on the ground, and we absolutely cannot leave it on the table. Which brings us to step 4, the tax optimization zone, maximizing IRAs, and the HSA secret weapon. This is the phase where we really play defense. It's the most critical advisory phase where we shelter your hard-earned wealth from the IRS so it can actually compound over time. Before you dump any more money into your employer's 401k beyond the match, because those often come with pretty high management fees, you absolutely must maximize your individual retirement account, or IRA. For 2025, that limit is $7,000. Now, you have a choice here, traditional or Roth. The general rule of thumb, if you're younger or in a lower tax bracket right now but expect to be in a higher one later in life, go with the Roth. You pay the lower tax up front and get tax-free withdrawals in retirement. But if you are a high earner right now, right in your peak earning years, you probably want to go traditional so you can deduct those taxes today. And next, we have what is arguably the single most underutilized investment vehicle in America, the Health Savings Account, or HSA. I tell my clients all the time, think of the HSA like a Swiss Army knife for your wealth, because it has a truly incredible triple tax advantage. First, you get a tax deduction when you contribute the money. Second, the money grows completely tax-free while it's invested. And third, your withdrawals are completely tax-free as long as they're for qualified medical expenses. It is the only account out there that gives you a tax break on the way in, while it grows, and on the way out. I always emphasize the long-term benefit of an HSA for retirement planning because the numbers are just staggering. If you max out your HSA contributions for 30 years and get a pretty standard modest 7% return, you could have over $400,000 in completely tax-free money waiting for you. And when you consider that the average couple is going to spend well over $300,000 on healthcare and retirement, having this massive pile of tax-free money acts as a secret weapon. It completely neutralizes the biggest financial risk of your later years. All right, on to step 5, avoiding the taxable trap, the reality of tax drag. Listen to me carefully here. Delaying taxable investments until your retirement accounts are totally full is absolutely vital. Only after you have exhausted your tax-advantaged accounts, like your IRA, that amazing HSA, and your 401k limits, do we even look at taxable accounts. But this is exactly where amateur investors wrongly start. People get totally mesmerized by the wild west of taxable accounts, right? They love the flexibility, they love that there are no contribution limits, and the ability to buy whatever individual stock or crypto they want. But they are completely ignoring the brutal reality of tax drag. In a taxable account, every single dividend payment is taxed. Every time you sell for a gain, the IRS steps in and takes a cut. It is exactly like trying to run a 10K while someone continuously throws handfuls of sand into your shoes. Let's actually run the numbers on what that jumping the gun mistake costs you mathematically. If you invest 10 grand a year for 30 years at a 7% return inside a tax-advantaged account, you're looking at about $944,000. Now do that exact same thing in a taxable account, paying taxes on your dividends and your gains along the way, you end up with closer to $700,000. That is nearly $250,000 difference lost entirely to taxes simply because you invested in the wrong order. Now, don't get me wrong, this doesn't mean taxable accounts are inherently bad. They just belong at the very end of the line. Taxable accounts are actually fantastic tools when you need complete flexibility. They're absolutely perfect if you're trying to bridge an early retirement before you can legally access your 401k without penalties. Or say you're saving for a house down payment that you'll need in 3 to 5 years. They're also great for estate planning if you want to leave money to your kids tax-free using the step-up in basis. They are the final beautiful capstone on your financial house, but they should never, ever be the foundation. Finally, step 6, your monthly progress checklist, the optimal blueprint. As we wrap up this explainer, I want to leave you with a highly concrete, simple monthly checklist. This is the exact sequence you can use to monitor your progress and know exactly where your next dollar should go every single month. Step 1, build that emergency fund. Step 2, eliminate that high-interest debt using the avalanche method. Step 3, secure your full employer match. Step 4, maximize your IRA and that incredible HSA. Step 5, go back and maximize your full 401k limits. And finally, Step 6, invest anything you have left over into those taxable accounts. If you follow this sequence logically, step by step, you are going to mathematically build serious wealth while everyone else is out there still just guessing. So the math is crystal clear, but the execution, well, that part is entirely up to you. I want you to take a hard look at your own accounts today. Be honest with yourself. Which step in this blueprint have you been skipping? And exactly how much is it costing your future self by doing things out of order? Fix your sequence today, and I promise you, your future self is going to be incredibly grateful that you did the boring stuff first. So, what's your first move going to be?